Welcome to the Utilization of Money Podcast with Tod Levine from Levine Financial Group. In this podcast, we teach our clients how to own their personal economy. Join us on this journey where we build upon your greatest asset as Tod draws from his years of expertise, solutions, strategies, and expert guest stories to help you understand how money works.
Hello and welcome to Utilization of Money with Tod Levine from Levine Financial Group. Good morning, Tod. How are you, man?
Hi, Eric. How are you?
Doing fantastic. We were just, before the podcast started, we were complaining about the cold, or I was complaining about the cold. You guys have had a pretty mild winter, but does that mean I'm old, Tod? If I'm complaining about cold and joints and stuff?
I'm not sure. I mean, I'm always cold, so I don't know. It could play a part, I guess.
All right. Yeah. Well, that's part of getting older. And I know today's topic is part of thinking about aging as well, for me at least, whole life insurance. And I don't know exactly why you picked this topic, but it's timely. It's, 2020. It's, we're still at the beginning, within the first quarter or so of 2020. And people need to be reevaluating what they're doing financially and what they do with their future. And whole life insurance can play a part, from what I understand, but I don't know a whole lot about it. So I'm hoping that that's what this podcast is about, and you're going to educate me.
Yeah, absolutely. Whole life insurance and protection as a whole is really, really important in every single financial plan. And I think I think whole life insurance, it's interesting because it's definitely misunderstood. And I think people understand as they're growing and creating wealth and adding liabilities, as their children are young, that they understand the concept of having some sort of protection in place, God forbid something happens. Mm-hmm. But I don't think they're really looking at the big picture of really why life insurance is so important to have, not just now, but for your entire life, and how it could actually be utilized during that period of time. Mm-hmm. So where most people are just viewing it as a pure protection play, it's really whole life insurance can be utilized in many other ways.
Yeah, and when I was younger, much younger, a new father, new husband, I had term life insurance, and that was because it was much cheaper than the whole life insurance that I had seen back then. Now, this is decades ago, brother. So it's not, whole life insurance today isn't the same as whole life insurance 2 or 3 decades ago. So I want to get down to the root basics of it. What is whole life insurance today? What is that?
So whole life insurance is good for your whole life. And I think that just to be clear, the definition is it's good for your whole life. So a lot of people get this one wrong because there's a lot of different products out there. There's universal life, there's term insurance, there's variable universal life, and then there's straight dividend paying whole life insurance. So when people say to me, well, I have whole life insurance, I'm like, fantastic, love to take a look. A lot of times it's not whole life insurance because it's not going to last their entire life. And there is a true value to knowing that this protection is going to be in place, not only now, but forever, until you pass. And that could be at 100 years old or 120 years old. And there is a value to having that in place at that point in time.
All right, so you've given us the definition, a loose definition of what whole life insurance is. And obviously in your definition, you're saying that there's different types of whole life, which again, then you talked about universal variable life, maybe, I don't know, term. It's very confusing. So let's drill down on whole life insurance. What are the benefits of whole life insurance, the kind that you recommend to your clients or the kind that you talk to your clients about?
Sure. So number one, it has level premiums, and level premiums is really important. So we understand that it's not really tied to the cost of the insurance, as in some products, where as you get older, the premiums could actually go higher. So the premiums are level, okay, and
Meaning they don't change?
They will not change.
Oh, okay.
Yeah, they'll just, and that's why it's important, obviously, to incorporate this at a young age, because the cost per thousand for insurance, and your health could be much better at a young age. So we can obviously put a lot more insurance on the books and in your portfolio for a lot less of a cost, or a lot less of a premium, and that level premium will continue on for a long period of time, or until the plan is fully paid up.
Gotcha.
In addition, there's also many uses of whole life insurance outside of just the permanent protection aspect of it. And there's also a savings vehicle, and it has guaranteed contractual growth components to it. The death benefit will not just remain level. The death benefit will grow over a period of time. And why is this important when we talk about the death benefit? Well, think about it. If you're just starting your career and you're making $100,000 a year, we are basing the amount of life insurance on something we call human life value. It's a multiple of the years that you're going to work and earn just this, not factoring in inflation. So, for example, if a young professional is in his 20s is earning $100,000, if his income just stayed here, we have to assume that he's going to earn, he or she's going to earn $3 million over that period of time. And that's really where we're looking at human life value, human capital. We really want to protect the future value of the earnings. When you look at it from an inflationary standpoint, if the income's growing at 3%, 4%, well, we're going to want the protection piece to continue to grow at that 3-4%, which this obviously in whole life insurance policies has the ability to do that. It will continue to grow. Now, obviously, if that person is going to have massive increases and go from $100,000 to $500,000 of income, then obviously it has to be readdressed, the amount of life insurance that's going to be needed, because obviously the human life value is going to change so drastically that we would have to obviously go in and add more life insurance. But from an inflationary standpoint, the death benefit's going to continue to grow over a period of time to keep up with keep up with the increasing human life value.
Fantastic. All right. Well, that sounds good, right? In theory, I don't know all the ins and outs of everything, but from my understanding, there's tons of uses for the whole life insurance policy during life and upon death, and that whole life is also an asset. Right? It's an asset class.
Yes. When we talk about protection, it's really, really important that we understand that obviously while we're growing and creating the wealth, we need to have protection in place. And that is really the common theme with everybody is they're like, well, they understand from now to time 65, this is kind of what's supposed to happen. Mm-hmm. Right? You're supposed to save as much money as you possibly can, pay off all of your liabilities, be able to put the children through school, and then hopefully when the kids get out of school, they can go on their merry way and start their own life. Mm-hmm. And then at the age of 65, it should be all perfect. The house should be paid off, the kids should be out of school. You should have plenty of savings that's gonna be able to generate approximately 60 to 80% of what your current earnings are, so you could sustain the same lifestyle, if not better, over a long period of time. And when I say all that, how many times do you think that actually happens?
Very few.
It's very rare. And some of the things that I hear often are, with families, couples, individuals coming in at, in their 40s, I start asking them about, everything and their situation and their kids and their family and their liabilities and everything. And I hear all the time didn't quite work out the way we wanted to. During these last 20 years, I had some challenges with my job and had to move to another job. Mm-hmm. Someone in our household was sick, so I had to grab money. We had to fund college, and so we weren't properly prepared for that. So we ended up borrowing from qualified monies and or taking from savings accounts. And during the way, we still were short. So we refinanced our house. So we actually owe maybe a little bit more on our house than what we should have at this point in time. It's nowhere being paid off. And this is kind of where we are, Todd. But the biggest challenge at this point in time at 50 and 60 years old, or in the late 40s, is this. So now I have nothing but liabilities when I thought I didn't, and I still need to work, which is a challenge. And the term insurance or the protection that I had in place is either not in place anymore or is not going to be in place very soon. So now I need to build this protection component into my life. Now, the challenges here at that point in time are, can we do that? Is the health there? Is it going to be cost prohibitive? What are our challenges? Where is the cash flow to get this done? And these are the biggest hurdles that we see when 20 years ago, the clients, their mindset was inexpensive protection in their minds, and then save all the rest of the money. And then at this point in time, this is what it's going to look like. So I'm not going to need protection. Mm-hmm. They weren't thinking about all the things that were potentially going to happen.
Yeah.
Now, if you kind of fast forward to the person who's at 65 or retirement and has built up assets and does have permanent protection in place, well, that person's financial plan is looking way different than the person who had just created some assets and has no permanent protection. Mm-hmm. So this is something that we call the permission slip. And it can really only be done with the permanent aspect of life insurance. So what we would like is for our clients to have an equal value of permanent protection to the assets that have been created. So it gives them then the permission slip to then spend down their assets appropriately and create more income from that portfolio and give them more flexibility, and to not disinvest their heirs in the process. So the person on the left who doesn't have the life insurance at retirement but has saved $1 million or $2 million, this is the way that person is most likely thinking. Okay, I have $2 million, part in my house, part in some cash, part in some retirement accounts, so we're here and we have to live and support ourselves for another 40 years. But here are also some things that I would like to do. Well, I have 3 kids and I would like to leave them something. I don't want to not leave them anything. So if in fact we're going to leave our kids something, then we need to just allocate that right away. So we have $2 million. Okay. So each one gets, I don't know, a few $100,000. Now we have what's remaining here and what has to happen. So we have to worry about longevity risk. We have to worry about what if one of us is going to need long-term care or is going to get sick. We want to travel. We want to be able to maybe make a wedding or give gifts to our grandchildren or do whatever. So what happens with the person on the left who doesn't have the permanent life insurance, now all of a sudden this asset's getting diminished. There's nowhere near the income that could be generated off that portfolio to even come close to the percentages of what they were earning. And they have to succumb to basically pulling off just a smaller interest rate off that money just to live, just to self-insure against all of these risks that we're talking about right now and all these things that they might want to do. Versus the person on the right side who might have the 2 million, 3 million, but was mindful enough about having this permanent protection in place that now gives them permission to actually be able to spend their assets down to zero. So by doing that, they don't have to live on interest of their assets. Mm-hmm. They actually have the liberty of spending down their money. And by doing that, they will be able to extract more income, which will give them a better lifestyle and will reduce their taxable income over a long period of time, and will also protect the legacy. So they're not going to disinvest their children at all. The 2 million or the 1.5 million or the 3 million is going to be secured and going to be guaranteed to be left to the kids. And at that point in time, they have all the options, the people on the right side. So it is really a myth, in my opinion, that when people are looking at protection, that they only need it from now to the time they're 65. I feel like they're really missing the picture. So when you look at dividend paying whole life insurance when you look at the permanent aspect of that death benefit, it becomes a really, really powerful tool to help distribute the assets. Now, the investment piece inside of, or the savings piece inside of the whole life insurance becomes a really valuable tool as well to help create wealth and to protect against any sort of areas in your life that are, or areas or things that are happening in your life over a period of time. So it's uncorrelated. It's completely uncorrelated to the equity markets. Okay. There's contractual guarantees and it grows tax-free. So when distributed properly, you can actually utilize this almost like a Roth IRA, but it's not going to be tied to a specific age or time frame, which is designated by the government. This is something that is controlled by you that you can utilize all the time. And one of the most interesting things about the asset piece of the whole life insurance is that when we talk about lost opportunity costs and we talk about our clients utilizing money and what really is the cost of the utilization, it becomes an interesting tool because it has a participating factor. Although the dividends are not guaranteed, the four major mutual companies have been paying dividends to these policies for a very long period of time, and they really have not missed at all. So although that piece inside the policy can fluctuate a little bit, it's pretty steady and consistent. So if our clients are borrowing from their plans or utilizing the money in strategic ways, then they could still benefit from these dividends that are going to continue to participate, which offsets a lot of lost opportunity costs. Whereas along the way, if they're looking to create assets and they're looking to pull money from an investment account that's earning 7 to 10%. Well, then by them taking that money out, they're going to be losing 7 to 10% in perpetuity, along with the tax liability, any sort of tax liability that would have been accumulated. So it becomes a really, really powerful tool as time goes on, not just now, in pretty much every area of their life. And this is why we, leading into the next area of, we utilize this as almost a gift of a lifetime. Obviously, the protection component is really the foundational piece, but the multiple uses that you can get out of it are really interesting.
All right, Tod, I know that we've got a couple other things to cover during this podcast, and you touched on the gift of a lifetime, and I want you to kind of dive into that a little bit deeper. And then you've also spoken about whole life insurance as part of estate planning. So I know that you wanted to touch on that as well, but I'm going to ask you a question, man. I couldn't even take notes as fast as you were talking. I mean, this is just like drinking from a fire hose. There's so much information and there's so much complexity to whole life insurance. And you've done a great job of really explaining some of that complexity. But I want to come back and do a part 2 to this podcast. Let's give them the rest of the meat. Let's go over the gift of the lifetime and estate planning. And then on the next podcast, I need you to give me some examples of what it looks like for a client to be able to do these different strategies, maybe 4 or 5 examples, walk through them with us so we can see it in real time, how whole life insurance plays a major part of anybody's planning. Can we do that?
Absolutely, yeah. I mean, that would be a great idea. I mean, listen, the whole life insurance is a vehicle. It's utilized in so many different ways. Mm-hmm. So obviously we could sit here for hours upon hours. So I love the idea of really doing a deep dive into some examples and planning scenarios, which I really think would clarify a lot of what we're talking about today.
Yeah. Absolutely. All right. So you call it the gift of a lifetime. What does that mean as far as whole life?
So a gift of a lifetime is something that, obviously there's tremendous benefits, and you could utilize it in so many ways. And so basically when we incorporate these plans on children and juveniles and we do, in our clients' grandchildren, and we call it the gift of a lifetime. And the reason why is it could be utilized in so many different ways. Obviously, some of the feedback that we get is, well, there is a life insurance component, and it's going to be on my children. And I'm like, listen, this is going to be a benefit that they're going to need at some point in time. Mm-hmm. Okay, but all the great uses we could get out of it, we shouldn't push aside because of that. And we could utilize it for college savings. We could utilize it for their first home purchase, retirement income, wedding, their first car, anything else that might come up in their life. And that's why we've named it the gift of a lifetime, because we feel that this is something that will benefit them so greatly as their life progresses. For example, my children, these were incorporated into their lives very early on, I think at 30 days old. And me and my wife always talk about using it for them to be their wedding gift. It will help them buy their first home. And so it is something that is very important, obviously, from the larger picture planning standpoint, from a foundational standpoint, from all those areas we discussed earlier. But for the children, it's great. It is gift of a lifetime, and honestly, for everybody, it's the gift of a lifetime, because there are so many uses and so many ways we can incorporate it into our clients' lives.
Yeah, so I'm looking forward to the examples on the next podcast, because I want to see how that works, and I guarantee there's a bunch of moving parts to that. So I really want to dive into that deeper, because that would be fantastic. I've got a couple of grandkids. I think you and I've talked about that before, and I've never thought about whole life for them. So I'm really interested. So I'm ready for that next podcast as well. All right, as far as estate planning, we've talked about that on previous podcasts as well, but I don't know if we've actually talked about how whole life insurance plays a huge part of estate planning.
Yeah, of course. I mean, estate planning is huge. How are people going to transfer their wealth? Mm-hmm. And how are they going to transfer their wealth in the most tax efficient way? And I think a lot of people are not really thinking about this. They're just saying, well, I have these assets and it's going to all flow to my estate. And at the time of our passing, our kids will, or our beneficiaries will figure it all out. And if there's real estate that needs to be sold, they'll just sell the real estate, and they'll cover the taxes. But it's really not that simple, right? And the permanent aspect of the life insurance, and a life insurance passing through at death really is clean and it's tax free. So it really gives you the ability to properly plan that transfer of assets and do it in the most tax efficient way. Mm-hmm. I mean, just to give you one example, I had a client who had some real estate and had 3 kids, and this person's idea of how she was going to transfer wealth was this: well, my kids are going to get the real estate. So there was a couple pieces of real estate. Mm-hmm. Now, there was one interesting piece to this, is that the kids did not all talk to each other. So her idea was, well, they'll get the real estate and they'll figure it out, right? They'll have to sell the properties and then pay the taxes, and assuming that they'll sell the properties at the right value, and everybody will be coordinated in regards to one wanting to sell versus one might not wanting to sell the properties. And I kind of just outlined to her potentially the risks associated with the way she was planning this exit strategy and some of the challenges that might arise. Whereas when you build in the life insurance, it's clean. Okay. So the life insurance could pass down to the children. And at that point in time, the real estate can actually be figured out. Maybe the market has corrected a little bit and the property values have gone down, so we're not forced to sell the real estate. Mm-hmm. Or maybe upon the sale of the real estate, there's basis and there actually is a tax liability that occurred that has to be satisfied right away, and the life insurance proceeds can do that. So really what it did is just kind of cleaned everything up, and obviously we built around all the trust and the estate planning around that and the legal docs around that to kind of describe the way she wanted to. She saw this happening, but the life insurance really just cleaned everything up, and really at that point in time she knew that by her passing away, it wasn't going to create more animosity and it wasn't going to create more challenges. It was actually to put them in a better position to be able to execute the liquidation of the estate and do it in the most, in the most timely way, in the most tax efficient way.
Gotcha. All right. What else about estate planning would whole life really help with?
Well, obviously, just really just the legacy to the children and grandchildren, and the fact that the assets get passed down, the life insurance proceeds get passed down in a tax-free manner, which is really clean. So back to my to the conversation earlier when we were talking about really protecting that legacy and not disinvesting our kids as you start to spend down your assets, is that it doesn't really matter if you're going to spend down your assets, because you're still going to be able to legacy the kids the proper amount of money. And one interesting piece too is that, I always say this is something that we talk about all the time, is like leaving the money with your eyes open rather than with your eyes closed. And I think the life insurance really gives us the ability to do that, because the permanent aspect of life insurance, you have cash values accumulated. When utilizing the cash values, all it's really doing is reducing down the death benefit by that amount. So our clients find that later on is, well, they might want to just see their kids enjoying that death benefit now, maybe they're going to do that by buying them a home or setting up grandchildren, paying for the college for the grandchildren now while they're still alive. And this is something that's doable, rather than just leaving real estate or something like that, because it's really hard to do it and access the money from those from other assets and do it in the most tax efficient way. So this is also another thing that we talk to our clients about, is like, leaving this money with your eyes open rather than with your eyes closed.
Yeah. Fantastic. All right. We are out of time, my friend. I know that this was a great podcast, a ton of information for you listeners. We're going to revisit whole life insurance on the next podcast with examples of how it can be incorporated into each individual life, right? So we're gonna give some good examples. Todd's gonna bring up some client examples, which will allow you to put yourself in their shoes. So it kind of you'll hear some things that should trigger you to say, you know what, that's kind of my situation, and wow, okay, if that's how that works in my situation, that may be a good idea, a good conversation to start. Todd, if people are listening now and they don't want to wait till that next podcast, how do they reach out to you if they want to just kind of start this conversation now?
Yeah, absolutely. Well, we'd love to speak to you. You could reach out to our office. We're located in Colts Neck, New Jersey. Our office line is 732-526-2922. Or you can just send an email to our office email at office@levinefinancial.net.
Fantastic. Thank you again, Todd. I look forward to that next podcast, man.
All right. Thanks, Eric.
You bet. And thank you all for listening to the Utilization of Money Podcast with Tod Levine. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when Todd comes out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thanks for listening today. For everyone at Levine Financial Group, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Utilization of Money podcast. Click the subscribe button below to be notified when new episodes become available.
Tod Levine, registered representative and financial advisor of Park Avenue Securities, LLC, PAS. Security products and advisory services offered through PAS, member FINRA SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is an indirect, wholly owned subsidiary of Guardian. Levine Financial Group is not an affiliate or subsidiary of PAS or Guardian. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. The human life value, HLV theory, states that one should maintain life insurance equal to the present value of their expected future earnings. Life insurance companies place limits on life insurance available to consumers based on this formula and have created age-based multiples of current income as a guideline. For example, a person in their 30s may be insured for about 30 times their annual income, 20 times for a person in their 40s, and 10 times for people in their 50s. Age 60 and over, about 1 time their net worth. Dividends are not guaranteed. They are declared annually by Guardian's Board of Directors. Policy benefits are reduced by any outstanding loan or loan interest and or withdrawals. Dividends, if any, are affected by policy loans and loan interest. Withdrawals above the cost basis may result in taxable ordinary income. If the policy lapses or is surrendered, any outstanding loans considered gain in the policy may be subject to ordinary income taxes. If the policy is a modified endowment contract, MEC, Loans are treated like withdrawals, but as gains first, subject to ordinary income taxes. If the policy owner is under 59.5, any taxable withdrawal may also be subject to a 10% federal tax penalty. All whole life insurance policy guarantees are subject to the timely payment of all required premiums and the claims paying ability of the issuing insurance company. Policy loans and withdrawals affect the guarantees by reducing the policy's death benefit and cash values. 2020-97191, expiration 3 of 22.